edition of the Fast Money Halftime Report. A wild ride this morning with the markets seeing heavy selling into afternoon trading as the European markets sink. The euro is, though, rallying. Here to help us make sense of all of this in a very special appearance, one of the fastest traders on the street, Mark Fisher of MBF Clearing. Also with us, our Fast Money crew live from the Skybridge Capital SALT Conference, Gary Kaminsky, CNBC's contributing editor, Anthony Scaramucci, and the liquidator, Joe Terranova. A handsome crew I've got from Vegas today. Mark Fisher, we're going to kick it off to you. We're seeing the volatility index hit extremes today. This is the markets are sinking. What's your bet in terms of whether we test the lows that we hit back on May 6th, which, of course, was the day of the flash crash?
I really have no idea whether we test lows today or tomorrow, but I actually think that people are getting the picture a little backwards because I think that everyone's running to gold, and I really think that the ultimate currency long-term is going to be energy and crude oil. And I think whether crude oil is down another 2 days or another 2 weeks, in the end, I think people are going to come to a realization that what China wants is what we should want. And if China wants to just keep buying every energy asset under the sun, that's what we should be buying.
Mark, that's a very revolutionary sort of line of thought. Gary Kaminsky, I would have never thought that somebody would come out on Fast Money to say that the flight to safety would be to crude oil or to the commodities, basically the industrial commodities that China's buying. Gary.
Yeah, look, Melissa, I think what Mark's point is, and I don't disagree with it, is that we've talked about with gold. Gold has unfortunately become this idea that that's a safe haven trade. And it's not a safe haven trade. Gold is now a speculative trade. It's become a speculative trade. I continue to believe that the VIX will go up here. I continue to believe volatility, certainly what we've heard here this morning, volatility will increase. If you're long equities, you want to hedge your portfolio, stay long the VIX.
Joe Terranova, I want to bring you in. I know you're long the gold trade. We had Dennis Gartman of the Gartman letter on yesterday on Fast saying that he is taking off his position in gold, and that seems, at least for today, to be a prescient call at this point. You are still long of the precious metal. Why, if we believe that other things are the flight to safety, in particular the U.S. dollar, how can gold actually find some support here?
Well, I think when we talked about it Monday night before I left New York about taking off gold, the trade did get a little bit crowded, and you're seeing weak longs move out of the market. But understand, gold is still a diversification tool. It looks like it's pulling back to the 1155, 1170 range, and investors have to have it in their portfolio. I would not short gold. I would be long gold, but in moderation. Anthony
Scaramucci, what's the buzz there at the SALT conference in terms of what the flight to safeties are in this sort of market? And the VIX hitting these extreme levels, is that at all a solace to you that perhaps we're hitting extreme panic and so therefore there'll be return to money into the markets?
Yeah, well, I definitely think there's been a cautious sentiment here in the early morning of the conference. But for Fast Money viewers will remember that we were cautioning people last week on gold. And to Mark's point, okay, gold is a valuable commodity, but it's not the only commodity. And it's got a 5,000-year history of being a quote-unquote reserve currency. But we are in a global economy now. Those other commodities that Mark is mentioning are more useful to the society, like oil. So we just want viewers to really have a balanced perspective. There's caution in the air here in the hedge fund community. There's over 1,500 people here. I would say 300 of them are hedge fund managers. And I say the air here is caution and tread carefully, particularly in equities.
And caution, especially because of the technical levels we've reached. The 200-day moving average, we should know, the S&P 500 is about 1,100, 1,102 to be exact. Right now, we are at 1,110, so that is a level we are watching very carefully. Meantime, let's hit our chart of the day. Mark Fisher, you are watching specifically the correlation between the S&P 500 and bonds. What are you looking for?
I actually think that it's a pretty easy picture to see. I mean, as equities decline, bonds have been bid up, and I think that's, you know, we're okay as long as that keeps going. But the first couple of days when you see equities go down and you see bond yields actually increase, I think that's going to be a big warning sign to everybody that you're going to then see people moving their assets, both out of stocks and out of bonds, and then looking for, I think, what's going to be the ultimate currency, which is going to be crude oil and energy in general.
Joe Terranova, are you buying into what Mark Fisher is selling? I mean, are you going longer oil these days? We should note that Goldman Sachs is head of commodities research today, also saying that he expects oil to go higher, and he also thinks that copper right now is a tremendous buying opportunity.
Yeah, I mean, and the guys at Goldman last week came out and talked about the longer-term story in oil, and I think that's what Mark is talking about right now. Spot oil's under pressure because of the inventory supply glut right now. You have to look past that. You have to look longer-term portfolio strategy. If you want to get defensive, you go to an ExxonMobil, you go to a Suncor, an Occidental. You have to have exposure to energy, and you have to look longer term, not in the moment.
All right, let's move on here. SEC releasing details of a new rules on single stock circuit breakers last night. As expected, trading in a stock would pause across the markets for a 5-minute period in the event that the stock has a 10% move up or down over a 5-minute period. Here's what Fisher had to say last week about the need for regulation.
If we don't go ahead and get our trading regs in place, this is going to spread to be a global situation that one day all these markets are going to disconnect and you're going to have more stocks than just ACN traded at a penny. And this would never happen if everything gets slowed down.
Mark, is this a slowdown that you were thinking of? The 5-minute rule.
Yeah, but I mean, I think it's relatively simple. If a major market index is down, 4, 5, 3%, you shut it down for an hour. If a major market index is down 7, 8, 9%, you shut it down for the day. You let everybody catch their breath, and you also allow these computers to get some human intervention. I mean, for lack of a better word, I was a trader in the pits for many years. And basically what's happened is all these locals, that's what I was called, have now migrated to where now the computers are now the upstairs locals. And they're just, what they can do is just, it's just in a second, I couldn't do in, 3 hours. And basically what I think the answer to the question is very simple. Slow everything down. I think what the CME has in place, when the market gets crazy, that they go into a state of suspension for 5 minutes. These are the answers that the market needs.
So, Mark, is it enough or is it not enough in terms of what is proposed?
I don't know if it's enough or not, but I think you try it. You cause no harm, which is the first part. See what happens and see if the market is able to, it responds favorably to it. If they do, great. If not, if you need a bigger dose of medicine, then you'd have a bigger dose of medicine. But I wouldn't go ahead, and give someone, a powerful drug. Let's first see if you just start with something like this and how the market takes to it.
Scaramucci, what's your read?
Yeah, what Mark is saying is very powerful, and it's a message to regulators, and we also have several of them here at the conference. We're in uncharted territory, so we need to go slow. In many ways, we're calling plays from the line of scrimmage like a football quarterback, and we're rushing. Regulators like absolute standards, and they like things that fit in a neat cookie-cutter way. This is not a cookie-cutter situation. It requires gradualism and experimentation, and that will restore confidence in these markets. So we need to listen to people like Mark that have this field experience. That's one of the purposes here of SALT today.
Okay. I want to move on and talk about the financials. They are the one